Hello, trader friends. If you want to understand how hedge funds run their investments, how hedge funds do their trades, if you ever wondered if you could trade like a professional, like a hedge fund manager, well, this video is for you.
I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry, and no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog.
So let's get to it. So today I'm going to teach you how to run a long short portfolio. Yeah, I know that sounds very, very fancy, very, very complicated, but guess what? That's all BS.
If you want to be fancy, hold your pinky up like this. The higher you hold it, the fancier you are.
How's that?
Higher.
Like that?
Now that's fancy. They should call you SpongeBob Fancy Pants.
All those hedge fund managers want you to think that it's very complicated to run a hedge fund, that is very fancy to run a long short portfolio. But guess what? It's not. And today I'm going to teach you how to do it. So the first thing we're going to do is I'm going to tell you what a long short portfolio is all about. In a long short portfolio, we have two components. One is the longs and two are the shorts. Yes, and we're going to start by using 100% equity, 100% stocks. There's only one rule that I'm going to ask you here is that the longs have to be bigger than the shorts. And why, Tony? Because the market tends to go up. So if you want to make money and you want to be smart, your longs have to be a little bit bigger than your shorts. I normally like to do maybe eight, 8 to 10 longs to 4 to 6 shorts. That's my ratio. And 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 then after we decided to run a long short portfolio, what is the next step? Well, the next step requires a little bit of time. It requires a little bit of research. But the cool thing here is you can pick any long stocks that you like, and you can pick any short stocks that you dislike, and in order to create your long short portfolio. And I'm going to show you what Uncle Tony came up with for our little exercise, for our little experiment, for our little rendezvous with our long short portfolio. So, as you know, we're watching here Uncle Tony's long short portfolio. For my longs, I decided that I would choose these stocks. Why these stocks? I decided that I want to be long FXY, China. Why? Because I think China has been beaten down too much. I want to be long TLT. Why? You don't really need to know why, because I think interest rates are going to go down. I want to be long Tesla. Why? Because it's down. It's been punished. Year to date, Tesla is in the little bit of a house of pain. Tesla is down 29% in a very, very bullish market. Apple is down 11%. I also want to be long India. I also want to be long this XLG, which is comprised of the top 50 stocks on the S&P 500, which means only the top runners. I also want to be long IAK. Why? Because insurance companies make a killing. Just check your insurance renewals. My car insurance went up, my home insurance went up, my umbrella insurance went up, every damn insurance that I have went up, my pet insurance went up. So I want to be long the insurance. And I also want to be long momentum. If you want to be long momentum, we go with SPMO. And what is momentum? Momentum is what we have been experiencing for the last 4 months. And now for my shorts. I decided to go short Boeing. Why Boeing? It's down 23% this year. And I do not enjoy doors opening on airplanes. I know they're fixing it. I'm sure it's already fixed, but Boeing has a lot of problems. I also want to be short corn. Why corn? I want to be short commodities because if we go into a little recession, commodities are going to go down. I also want to be short KRE. Why? Who the hell cares why? I'll tell you why. Because regional banks have had a big recovery, and I think the risk is not over. I want to be short utilities. Why? Because I think utilities have gone up too much, and I think if interest rates go down, XLU will be hurt. I also want to be short Airbnb. Why? Because we own an Airbnb and bookings are down. Bookings are down on Airbnb. And I want to be short Nvidia. Why? Because everybody, the grandma, the taxi driver, everybody's long Nvidia. My friends are long Nvidia. Everybody I know is long Nvidia. So everybody's long. Uncle Tony wants to be short. I know I might get killed, but that's part two of the video. So now that we have chosen we are the chosen ones. We have chosen our long short portfolio. Now we have to size up these beautiful positions. How? Well, let's count them. I have one, two, three, four, five, six, seven longs. And I'm going to pretend I'm using $1 million for this portfolio because I want to be a normal human being. I'm going to invest $100,000 in each of one of these seven stocks. And for my shorts, I have one, two, three, four, five shorts. I want to be short $100,000 of each of these five stocks. So I'm going to be long $700,000, 100,000 each on my long stocks, and I'm going to be short $500,000 on my shorts. Now, if you don't have a portfolio of $1 million, no problem. You can size it down. You can size it down to fit your portfolio size. You can also change my longs to whatever longs you like. You can change my shorts to whatever shorts you like. This is the cool thing about trading. The cool thing about trading is you can do whatever you like. I'm just going to teach you how I do it, and then use this framework, use this information to create your own recipe, to create your own sausage, to bake your own cookies, and then we can have some fun. Now let's take a look at our portfolio that I have sized for us today. Here we are. So these are the stocks that I want to show you today. We are going to be long 500 shares of Apple. Here we are. We're going to be short 500 shares of Airbnb. I know. If you multiply 500 by 170, is not $100,000 exactly. But these, remember, if we're going to use derivative against our positions, but derivatives have multipliers of 100. So I sized everything up to the nearest 100. So back to what we're talking about. We're going to be long 500 shares of Apple. We're going to be short 500 shares of Airbnb. We're going to be short 4,000 shares of corn. We're going to be long 4,000 shares of FXY. We're going to be long 800 shares of IAQ, the insurance thing. We're going to be long 2,000 shares of India. And shout out to all my Indian friends who I love. I have so many Indian friends who are so smart and so nice, and that's why I'm long India. No, I'm long India because of my friends, and I'm long India because the country is going through the roof. I also want to be short 2,000 shares of KRE. I want to be short 100 shares of Nvidia. Why 100 shares? Because I want to survive to live another day. I also want to be long 1,000 shares of SPMO, the momentum. I also want to be long 1,000 shares of TLT. I also want to be long 500 shares of Tesla. And I want to be short 1,500 shares of XLU, baby. So now that we have constructed our little recipe, our little pot of ingredients, the first thing I like to do is I like to beta weigh. What does beta weigh mean? Weighting means that you are converting everything to a single underlying. And all these shares that we have here, I'm going to beta weight them to the SPY. So the first thing I like to do is to beta weight. Beta weight means converting everything into something that I'm very familiar with. And I'm very, very familiar with SPY because my brain thinks in spies, in spiders, in S&P 500. So let's go and let's beta weight our portfolio to SPY and see what the hell we have. So all this crap that I created, now that it's all beta weighted, we can see that actually our portfolio is only long 123 deltas of SPY. And what does 123 deltas of SPY mean? Means that all that stuff that I am long, all that stuff that I am short is equal to 123 deltas of SPY. And let's do something cool. Let's do something interesting. Let's stop the beta waiting. Let's go to SPY and let's try to sell 100. And let me see here. We go to SPY. We go to add simulated trades. And here we have it. If you want to neutralize your portfolio and you are long 123 deltas of SPY, one of the easiest ways to neutralize your portfolio would be to sell 123 shares of SPY. If we were short 123 deltas, the way to neutralize your portfolio would be to buy 123 shares of SPY. But since our simulation gave us 123 long deltas of SPY. And why are we long delta? Because remember, Uncle Tony likes to have more longs than shorts. More longs than shorts should give us a long portfolio. A long 123 deltas is a long portfolio. Now, if we go here and we sell, here we go, we're selling 123 shares of SPY, boom, automatically we are neutral. We neutralize our portfolio. Now, why would you neutralize your portfolio? I don't know. Because maybe you're going on vacation. Maybe you're scared that the market goes down. Who the heck knows? But if you want to neutralize your portfolio because something scary might happen, you can use your shares of SPY, buying or selling them to neutralize your portfolio. But that is not the point of this video. The point of this video is showing you guys how to run a long short hedge fund. So what have we done until now? Number one, we decided to be a fancy hedge fund manager. Number two, we went and saw charts, analyzed fundamentals, or whatever you want, and you guys chose a list of long stocks. Then you analyze, you looked at charts, you did whatever you want, and you found a list of short stocks. Then you sized all those stocks up, meaning you gave equal value to your longs, equal value to your shorts. Then you went into your trading platform and you beta weighted those long shares versus your short shares. And to validate that your beta weighting was correct, you either sold or bought shares of SPY to neutralize your portfolio. Remember, those buying and selling of the SPYs, we're not going to use for our hedge fund. I just wanted to present you, if you wanted to neutralize your portfolio in that moment of time, that is what you do. Now, that is a long short portfolio. But since we are tasty traders, since we are smart, since we use our brains to create money, and since we know how to trade derivatives, there is something extra you can do to create alpha. Now, if all my long assumptions go right and all my short assumptions go right, then I'm a genius. My longs go up, my shorts go down, and my long short portfolio goes through the roof, and Uncle Tony's minting money. But that's not really how it happens. Some of my longs, I know I'm going to be losing on them. Some of my shorts, maybe Nvidia, will keep going up, and I might lose on them. So I want to overlay something. That sounds very fancy. What the hell is an overlay? So an overlay is selling derivatives against your positions. So think of it, if you have longs, you sell calls against your longs, making covered calls. And then if you have shorts, you sell puts against your shorts, creating a covered short position. Now let's go to our trading platform and let's create one by one this overlay. So I like to start with my long position. So my first long position that I decided to buy was Tesla. We bought 500 shares of Tesla, and let's try to do some overlays here with Tesla. Remember, trader friends, we're running a long short hedge fund and we're going to overlay our positions. If we have 500 shares of Tesla, how many calls can we sell against our 500 shares? We can sell five. Five, why? Because 500 shares, each option is 100 shares. We can sell five. Now, you can decide to sell one, two, three, four, or five. I don't care. If you're very bullish on Tesla, only sell one. If you are neutral on Tesla, sell five. If you are kind of then sell three. And also, you can play with the number of options you sell against your positions, but also you can play with how close to the money or how far from at the money you're going to sell your shares. I normally like to sell my shares around a 30 delta. So here we are, we find the 30 delta, and I'm going to sell five. One, two, three, four, five. Five beautiful, five gorgeous options of Tesla. Now, because I like graphics and most of you like to look at charts, look at graphs, let's see what the hell we did. First, we had 500 shares of Tesla. With 500 shares of Tesla, we have 500 deltas. Here, look at my mouse, 500 deltas. If Tesla goes up, we make money. If Tesla goes down, we lose money. Okay? Now, this example, I'm going to do it just for Tesla. Why? Because I don't want this video to be 5 hours long. Now, what the hell did we do? We added five short calls. So our chart got topped out. Why topped out? Because we have the equal amount of short calls than we have stock. If you are more bullish on Tesla, let's go reduce. You can reduce the number of calls, and you can see if we only sell three, the chart keeps going up, up, and away. If we reduce it to one, it almost looks like a stock. But for this example, I'm going to sell five shares of my Tesla stock. And how much money are we collecting? We're collecting 735 per option. We have five of them. That means we are enhancing our position with 3,675 bucks. And those 3,675 bucks, you know what they mean? They mean that this amount of money is going to go into our pockets immediately. That amount of money is going to reduce our cost basis. And remember, trading trading is reducing cost basis. The only thing good traders do all the time is reduce their cost basis. So by selling the calls against our 500 shares of Tesla, we are reducing our cost basis. Remember, if you're more bullish on Tesla, sell four, three, two, one. If you're less bullish on Tesla, sell five. For this example, I'm going to maximize. I'm going to maximize the number of shorts and longs that I have against my short long portfolio. So, what we did with Tesla, you guys are going to do it with every single one of your longs. Number one, you're going to decide how bullish you are on those longs. If you are iffy, you can sell the same number of calls against the number of shares that you have. We have 500 shares of Tesla, you can sell 500 calls. If you are not so bullish on Tesla and you're in, you can sell four, three, two, one, but at least sell one. You know why only sell one? Because you might be wrong. So, maybe sell one or two or three against your Tesla if you're very bullish, but I'm going to sell five. Now, since I don't want this video to be super duper long, let's go and take a look at a short position. Yes, a short position. So remember, we are short 500 shares of corn. And you know what? Let's go with something more exciting, something that is hot right now. NVDA, NVIDIA, baby. Nvidia. Remember, we're going to follow Tasty Life commandments. We're going to go 45 to 60 days. Since April is 41 days and March is 69 days, I'm going to go a little further up. And why Tesla? Because Tesla is hot. Everybody's long Tesla. Everybody buys zero DTE Tesla calls. You know what's going to happen to those guys? Same thing that happens to the guys buying zero DTE Nvidia calls on Friday. They lost money, lots of money. But anyways, let's go to my 30 delta. That's what we're going to choose. And here I'm going to sell the 1030 strike call. Boom. Why one? Because I only have 100 shares of Nvidia. Sorry. Uncle Tony made a mistake. Uncle Tony made a mistake. What mistake did I do? If Uncle Tony's short 100 shares of Nvidia, we do not sell calls, because if we sell calls, we are double short Nvidia. Gotcha, everybody. I wanted to see if you were paying attention. If we are short 100 shares of Nvidia, we're going to sell puts against it, because a short put is a long position that goes against our short stock. If we have long stock like Tesla, we sell short calls against our long position. So now that I see everybody is I was able to wake everybody up. Here we are. We have 100 shares short of Nvidia. We can sell one put against it. And how does this look? First, let's take a look at our short Nvidia stock. If it goes down, we make money. If it goes up, we lose money. Chances are Nvidia is going to go up, because it always goes up. But since we don't know what's going on, we're going to sell that short put of Nvidia. And for one miserable put of Nvidia, we are going to collect $37.50, which means we are collecting $3,750 back into our pockets. So remember, with Tesla, we pocketed $3,600. With Nvidia, we're pocketing $3,500. Now you're starting to get the point. We have $7,000 in our pockets, trader friends. $7,000 just with these two stocks. And in Nvidia, we don't have the same luxury that we had with Tesla. We only have 100 shares of stock. We can only sell one put against it. Now, if you're very on Nvidia, you can avoid selling the put. But since Nvidia is very bullish right now, you should sell the put if you want to be short Nvidia. When I was growing up, I used to love watching cooking shows. Remember Julia Child? And remember, she used to put like a turkey in the oven, and immediately, by the power of television, she would pull out 5 seconds later a cooked turkey. So, this is what I did right now. For you guys, so we don't waste a lot of time, I went in every long stock that I had and sold calls against it on the 30 delta. Once again, for every long stock that I had, I went in and sold the same number of calls on the 30 delta that I had, 45 to 60 days out. For every short stock that I had, I went in and sold one put for every 100 shares that I was short. And now let's use the magic of television. And here's what I did. So if you can see here, I had long 500 shares of Apple, I sold 5 calls. I was short 500 shares of Airbnb, I sold 5 puts. I was short 4,000 shares of corn, I sold 40 puts. And I was long 4,000 shares of FXY, I sold 40 calls. Blah 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 blah. So what does if all this crap that I sold came out to? Look at this. Without any stock, my deltas are -8. What does that mean? It means even if I don't have that long short portfolio, my portfolio is pretty neutral, pretty neutral. And now let's take a look at our extrinsic value. So guess what? Guess what? We are collecting a lot of money, a lot of moolah. We are collecting thousands and thousands and thousands of dollars by doing this portfolio. Now, I just clicked on everything that I had, and look at that, boys and girls. We are now, I selected all the stocks and I selected all our options, and we are collecting 372 theta points every day. If we multiply that by 30, that means we're going to be collecting $11,000 per month. If we sold them at 60 days, that means we're going to collect about a little over $20,000. What does that mean? We are collecting another 1 to 1.5% of extrinsic value against our positions. If we do this every single month, we're going to collect call money from our longs. We're going to collect put money from our shorts. And all that stuff adds up to a lot of money. If if you want to collect more than that 1 or 1.5%, what can I do? What can I do, Tony? I want more extrinsic. I want more theta. If you want to collect more extrinsic and more theta, what you do is you move those sold options, you move the short calls closer to at the money, and you move your short puts closer to at the money. And then the circus tent, the little thing, your extrinsic value will probably double. And instead of collecting $11,000 a month, you might collect $20,000 a month. And that's more interesting. And if I were you and I was running a long short portfolio, I would do that. I would be very aggressive selling calls and puts against my positions. Why? Because I want to collect that theta. And imagine if we can collect, that 2% a month, plus we are right in our positions, that maybe gives us another 1 or 2% a month. So we could be making 3 to 4% every single month. And that's how hedge funds do it. And that is the magic of running a long short portfolio. Actually, the modern hedge funds are not really long short. They're not even hedged. The only thing that hedge funds do right now is they find a momentum stock like Nvidia, they buy at the money calls, which is a terrible trade, and they pray that momentum will take the thing higher and run with it. They just lever up like crazy. They go into margin. They risk the biscuit to get the biscuit, baby. They risk it. They want everything. And I wanted to teach you how to run a smart long short portfolio. And that's it, boys and girls. You see, it's not that hard. It's not that difficult. They make it sound so hard, and they charge you 2 and 20 for that. I call that BS. Now let's recap because I love recap. So, if you want to run a long short portfolio, what do? First, you have to start with a premise. Your longs must be bigger than your shorts. Longs here, shorts here. More longs, less shorts. Okay. Now we're going to size up number two. We're going to size up our positions to be equally weighted. In this fictitious $1 million portfolio, I chose $100,000 long of my long stock, and I chose $100,000 short of my short stock. And because we have to round them out to the nearest 100, so it's sometimes you're long 95,000 or 105,000. Sometimes you're short 105,000 and then long 95,000. So it's just in the ballpark. The third thing you do is you go and look for stocks that you like. I liked, here's my list of longs. I like Tesla, Apple, TLT, FXY, India, insurance and momentum. And the shorts, I wanted to be short corn, regional banks, utilities, Airbnb, and Nvidia. And when you decide that, you buy all your longs, you sell all your shorts, and then you beta weight. Why you beta weight? You want to make sure that you are long delta. And how can, after beta weighting, if the deltas are positive, in our case it was 123 deltas, in that case that means you did it correctly. You had more longs than shorts. Now, if after beta weighting you think that you're not long enough, well, then add more longs. And after beta weighting you're too long, then add more shorts. This is just a recipe. You have to match your portfolio to your risk profile. You have to match your portfolio to your liking. See, if you like your cookies sweeter, add more sugar. If you like your bacon crispier, let it cook a little bit more. It doesn't matter, but just make sure that you're a little bit long deltas. Number three, number, who knows what number we're in. Then after we found our stocks, we bought them, we shorted them, we beta weighed them, then we're going to sell derivatives against them. Remember, if you have 500 shares of Tesla, you can sell 1, 2, 3, 4, 5 calls, up to 5 calls. Why? Because we don't want to be naked on that side. And for my example, I sold the maximum number of calls and puts. I chose the 30 delta. If you sell the 30 delta, normally you're going to get 1.5% of theta a month in your portfolio, which is great. If you want to be more aggressive, sell your calls and puts closer to at the money. That will give you about 2 to 2.5% of theta every single month. And how do you manage this? So if the shorts go down and they take away your shorts, let them take it. If your longs go up and they take away your long stock, let them take it. You can find a new long, or you can reestablish the same long. The best thing that could happen after you sell those derivatives is that you end up with nothing. When all your shorts went down and they took them all away, and all your longs went up and they took them all away, bravo, great. That means you made probably 4 to 5% in that month. And if you have a 3 to 4 to 5% one month, guess what? You are minting money. You're risking it to get the biscuit, babies. So there you have it. You see, hedge funds make you want to feel that they're so smart. They have to justify their 2% fees and their 20% of the profits. Now, if you want to grow your pile, run your portfolio like a hedge fund. Grab a long short portfolio, sell derivatives against it, follow Uncle Tony. And most importantly, you gotta risk it to get the biscuit, baby.